Thank you for joining us for our third podcast. Today we are exploring top tax planning tips for individuals. I'm Vicky Foster and I'm joined by Amy Thompson, HB Accountants Tax Manager, and her tax assistant manager, Sabrina McCarthy. Thank you both for joining us. Personal tax planning isn't just for the wealthy, it's for everyone. And today we're looking at the key steps individuals can take before the tax year ends. I do need to mention that HB accountants are governed by the ICAEW. Our podcast is for general information purposes and not intended to constitute investment, tax or legal advice. We recommend you seek independent financial advice before making any investment, tax or financial decision. And please remember, tax treatment is dependent on individual circumstances. Amy, thank you for your time once again today.
Yeah.
Big hello to Sabrina again, our assistant tax manager here at HB Accountants. Thank you for your time. What are some quick wins that individuals can take before the tax year ends?
So if we break it down into different types of tax, I'll start with income tax. So personal allowances remain frozen. They are eventually apparently going to start going up. So at the moment, you get £12,570 tax-free a year. This starts to get mitigated when you earn over £100,000 and you can face a steep effective tax rate. So you definitely need to consider as to whether your income is going to be over £100,000 for the tax year. There's ways to mitigate the going over this threshold, for example, by using gift aid donations, maximising your pension contributions, which you can do up to £60,000 a year, but these can be tapered down if you earn over a certain amount. You can also carry forward the last 3 years of unused pension contributions. So consider this with your financial advisor or your tax advisor, but that's a really good way to reduce that £100,000 threshold, because once you go over that threshold as well, you also start to lose things like tax-free childcare and free childcare. So it's really important to consider that. Another thing to consider is also child benefit. If you're claiming child benefit and someone within the household, so, could be mum, dad, stepmum, stepdad, earns over £60,000, that also starts to get clawed back from HMRC. If you earn over £80,000, that gets taken away completely. So definitely consider your income for the year and ways you can reduce that to ensure you're getting the maximum benefits available.
If I go into capital gains tax, there was quite a lot of changes back in October where the rates have now increased to 18% and 24% to match the residential rates where they were 10 and 20%. But there is still the 10% business asset disposal relief up until April 2025. That rises in April 2020 till April 2026 to 14%, and then goes up to the basic rate band of 18% in April 2026. As a tip, if you're planning on selling assets that will qualify for business asset disposal relief, it might be worth considering selling it before April 2025, and if not, April 2026, in order to benefit from the lower rates. Another strategy you can use is if you are married, assets transfer between you and your spouse at no gain, no loss. So you are able to take advantage of both of your annual exempt amounts in order to minimise capital gains tax.
With regards to pensions as well, definitely some quick wins to do with that. So your pensions can allow you to extend the amount of tax you pay at the basic rate of 20% and the higher rate of 40% if you're an additional rate taxpayer. So you pay a net amount into your pension that's then grossed up by HMRC by 20% if it's a personal contribution. And then you can also extend your basic rates, the amount you pay 20% tax at, by the amount you've contributed into your pension personally, and your higher rate amount if you are an additional rate taxpayer. So really consider that, because a lot of the time we find higher earners who pay privately into their pensions will receive quite large refunds of PAYE because they're paying tax under the PAYE scheme. That's where your tax is deducted at source as an employee. So definitely consider that, because that also brings down your gross income for tax purposes. So it will reduce your whether you meet that £100,000 threshold. So
can I ask a question?
Yes.
Is that the same as a salary sacrifice?
Salary sacrifice is slightly different. So salary sacrifice reduces your gross income at source. So for example, you're paid £2,000 a month, you contribute £500 a month via salary sacrifice, your gross income will be 1,500 for that month.
That's the bit you'll get taxed on.
Exactly. So you get tax relief at source at that point. When you're paying into your pension privately, you receive tax relief usually via your tax return. You can do it via your tax code as well, but it's a really good way if you look at your income at the end of the year and you think, oh God, I'm going to be over, £100,000. You can then make a private contribution, which will bring that down as well. So definitely something to consider. But also do make sure that you check the annual allowance rules with your tax advisor or your financial advisor, as it's £60,000 a year but can be tapered down if you're a higher earner. Plus, like I said earlier, you've got those 3 years carry forward of unused allowances, so definitely make sure you look into that before you make any large contributions.
Another big change is the changes to the Furnished Holiday Let scheme. That is being abolished from the 5th of April 2025. So you have a couple of last minute planning opportunities that you can do, but you do need to make plans now to do them, because you do need to completely cease trading as a Furnished Holiday Let before the changes come in order to benefit from the capital gains tax relief, such as business asset disposal relief and rollover relief. And the whole Furnished Holiday Let business needs to cease before the changes come into place. So if you do have a Furnished Holiday Let business, it is definitely worth talking to your tax advisor before April to make sure you know what your situation is.
Or if you're currently drafting your own tax return, it might be worth getting in touch with an accountant or a tax advisor prior to those changes taking place.
There are big changes coming in. That's
another really good way to save some tax before the year end, if you've got some extra money you'd like to invest, is by investing into an EIS, SES or VCT investment. This can give you upfront tax relief based on the amount of investment you make. So you receive something called a tax reducer. So the amount you invest, you either get 30% or 50% of the amount you've invested taken off your tax bill. So again, you would need to speak to a financial advisor for sure before you make these investments, but it's definitely something to consider if you've got some spare money and want to save some tax.
Okay. And what about ISAs? Can people still take advantage of an ISA?
Yeah, so ISA allowance is £20,000 per tax year for each individual adult and £9,000 tax year for junior ISAs. So we'd always advise clients, if they've got some money, sitting around that's not in an ISA, make use of those allowances prior to the tax year end on the 5th of April. So any growth in an ISA is free of UK income tax and capital gains tax. You cannot carry forward these unused allowances, so definitely make sure you make use of them. So with regards to pension planning, like we've said a few times before, pensions are really, really tax efficient, so definitely something to consider prior to tax year end and also for future planning. So paying into your pension privately results in an increase to your basic rate bands and your higher rate bands. Paying in via your salary, via salary sacrifice, reduces your gross income for tax purposes for the year. Obviously that's going to grow, and be used for your retirement. But something to consider is from the 6th of April 2027, they are going to be included in your estate for inheritance tax purposes. So it's really important to start utilising your pension if you are at retirement age or over the age of 55, where you can take your lump sum tax free, to start, using up that income. So again, speak to your financial advisor if you are at retirement age and can withdraw from your pension, because those changes coming into play from the 6th of April 2027 will mean you pay 40% tax on any unused pension if you're over the inheritance tax free amount. So
okay. And what tax saving opportunities exist for self-employed individuals?
The main one is just making sure you're claiming all of the allowed expenses. There's many that are often missed. Things like your business travel, which like travel to clients, travel to meetings and things like that. Though that doesn't include a permanent workplace. Oftentimes businesses can struggle to keep track of how much of their car is allowed and how much isn't. So HMRC do allow a flat rate mileage allowance for business travel. The other one often missed is working from home expenses. If you work from home as a self-employed person, you can claim part of the cost of running your home as a business expense
So that's even if you do some admin from home, it doesn't have to be full-time working from home. So take a self-employed plumber who does with bookings from home, can still make some claim for working from home expenditure.
You would apportion how much of your house you use just for business and allow for that. The other one would be subsistence allowance. If you are travelling for work, that you are allowed to claim subsistence, and also any safety clothing. So if you take the plumber, for example, if they need any safety equipment like steel-toe boots and things like that they need for their job, that would be
protective equipment.
Things like that are allowable expenses for self-employed people.
And what about if you're feeling super generous? What should people know about gifting money, inheritance tax plan?
Yeah. So currently the nil rate band, which is the amount that you don't pay inheritance tax on, the amount of money you can have in your estate, is £325,000. An additional amount of £175,000 is available if you are gifting your main residence down to a lineal descendant. So obviously that's transferable between husband and wife as well. So that can bring total allowances between a married couple up to £1 million. So that is there and is available, and is something to make sure that you are aware of how much you have available to you and keep track of the value of your estate. Regular gifting can reduce your taxable estate. So £3,000 per year you can gift without any IHT issues. You can also carry forward 1 year of that gifting allowance. So you could gift £6,000 in 1 year per individual if you didn't use your prior year's allowance. You can also give small gifts of £250 per person per year for inheritance tax purposes, and there's no consequences. So these things can reduce your estate. Gifts out of income. Now, this is especially important considering the changes to the pension rules. So pensions are going to fall within inheritance tax from 2027. Any excess income that you have, you can gift free of inheritance tax. So say I earned £5,000 a month and I only needed £3,000 of that to live. I've got £2,000 of excess income. I could gift that to a child or a grandchild, or anyone really, and it would have no inheritance tax consequence. So it's a really good way, especially if you've got excess pension income, to start getting it out of your estate, so it's not going to be subject to that 40% tax. Also, potentially exempt transfers are a really good way of reducing your estate for inheritance tax purposes. So you can make a gift of any amount really, and as long as you survive 7 years from the date of making that gift, it won't be subject to inheritance tax. So it's really good to start planning now. We always find people want to plan on their deathbed and it's never efficient. So it's horrible talking about death, but you really need to make sure that you start planning to ensure that you're maximising your reliefs for inheritance tax and not paying, 40% tax on that hard-earned money.
Yeah. Are there any overlooked deductions or credits that our listeners should be aware of?
For employees, there's things like your employment-related expenses, main one being your professional subscriptions. If you have to pay for them rather than your employer paying for them, that is an allowable deduction for your employment income, and therefore you can get tax relief for that. The other ones are if you're self-employed, your working from home expenditure, and if you have a side hustle, your trading allowance, you can earn £1,000 free of income tax. If you rent out part of your house, you've got rent a room relief where you can earn £7,500 a year free of income tax. And also, if you do rent your house out or any property out, you can have £1,000 rental income tax free. That's often great if you're going on holiday, and people will sometimes nowadays rent their house on Airbnb while they're away. That then if you earn under £1,000 for that week or whatever you're away, that's free of tax.
And that's gross before expenses. So yeah.
Interesting. And the obvious suggestion would be go speak to a tax advisor. How's that going to benefit you? I think the key thing really for everyone to remember, smart tax planning helps you keep the money potentially in your pocket. A huge thank you to you both for joining me today. As always, if you would like to receive an email summary of what we've covered, just drop us a message and we'll send the details your way. Lastly, thank you for joining us. We look forward to supporting you on your onward financial journey. Please do remember that any information shared in the podcast is for general information purposes only, does not constitute professional advice, and while we aim to provide accurate and up-to-date insights, HB accountants and any of our guest experts are not responsible for actions taken based on this discussion. We'd recommend you always seeking professional advice suited to your specific financial or business circumstances. Thanks so much for listening.